We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Robert Sinn. He's an investor, trader, and market commentator focused on precious metals, junior mining, and biotech with 21 years of market experience. He's also the author of the Goldfinger Capital Substack. Robert, welcome to the show.
Tom, thank you very much for having me. I guess I finally made it in life. I get to be a guest on your show.
Well, I appreciate you accepting the invite, and I'm looking forward to a wide-ranging conversation today. But I thought we could kind of start by having you explain a little bit about what has brought you into the precious metal space as someone with, such a diverse of an investing appetite as yours.
Yeah, so my genesis story in precious metals starts with my father. And in the 1990s, my father turned into a gold bug. He was an investor, an inventor. He invented the first stock quote system in the 1960s that stockbrokers had on their desks, sold it to General Telephone in 1970. Fast forward to the 90s, he's in his 60s and he's reading about the government debt bubble, the problems with the dollar, as the reserve currency. And he starts taking a very positive view of gold as an inflation hedge and a way to keep his purchasing power, as an investor. So in the 90s, I spent some of my 12, at age 12, 13, 14, following my father around to coin shows, buying gold at $300 an ounce. So that's kind of how I got started. And I guess you could say that being there with my father was a very formative experience for me. And obviously we tend to follow in our father's, footsteps. So the fact that he was a gold bug kind of made me a gold bug. And then later on, he got involved in junior mining, as an investor around 2002 and 2003, and ended up accumulating quite a formidable portfolio of junior mining stocks during that 2002 to 2008 bull market run. And then obviously the global financial crisis happened and things went south in a very violent manner. But I learned a lot from, observing him as an investor and what he would share with me, the stuff he was reading, the stocks he was buying. And I learned a lot that way. And then obviously he passed away in 2017 and I've sort of taken up the torch myself and learned a lot on my own, as an investor and commentator on metals and mining.
Mm-hmm. So when we consider what you're interested in, let's say from biotech to commodities, is this a deliberately uncorrelated strategy, or are these just areas that draw your interest and therefore your attention?
They draw my interest. And so junior mining and biotech have a lot of similarities in that they're high risk and high return. There's a high potential payoff if a company has a really positive phase 2 trial for their drug candidate, the same way that if a company puts out a blockbuster PEA and wows the market with incredible, rate of, return, then you could get tremendous re-rate. So biotech and junior mining are very similar. Also, one hole in junior mining can change everything, and it could give a company a 10x appreciation in a short period of time. Same thing, one trial or one spectacular set of data can also do a 10 or 20x in biotech, right? But also the failure rates are very high. So I guess you could say I'm a bit of a gambler, in that respect. But both sectors really interest me because we need new drugs. We need biotech to achieve a higher quality of life as a human race, and we need metals for progress. So I look at these sectors as the foundation of the world. And
Yeah, it's very interesting, and I see that correlation, let's say, of high risk to high reward being very exciting, and having a game changing hole or a game changing drug. I could see that completely changing that company's future. Robert, I'd like to turn to talking a little bit about the Fed. With the backdrop of the announcement last week of the Fed tapering QT, how do you expect the market to react to start positioning in reaction to this news? And what do you think the Fed is actually reacting to?
tricky question. I mean, so I spoke at a conference in January in Vancouver, and at the time of that presentation, I think it was January 20th, I said I expected the Fed to taper quantitative tightening probably in the next few months. That was January. So it was a little bit off in my timing, but I think most market participants had expected this announcement of the taper.
Mhm.
And the Fed is setting the stage for more easing. And obviously, Powell has had a number of press conferences in the last 6 months where he's been on the dovish side in terms of his tone. And in some of those press conferences, a lot of market participants were a bit puzzled because they're like, why is he talking about the likelihood of easing when inflation is still not back to target and the employment market seems to still be quite strong, you know? And I think there's a lot of answers to that. I think the main one is due to, fiscal dominance. And that is just the fact that to finance this budget deficit, this federal, deficit and the overall debt pile of $35 trillion, the Fed cannot stay at 5% on the Fed funds rate for much longer. And also, the Fed may be seeing some things that we may not be able to see as average people and just observers who read the headlines and see the data that the government allows us to see. Okay, there could be some more to the story that we're not quite, um, that we're not quite able to grasp.
Mhm.
And in fact, when he gave the press conference on Wednesday, my intuition, like my spidey senses, said he knows what the jobs numbers are going to be in 2 days,
Mhm.
and he's seeing some more data that we're not seeing yet, and it's softer data. And sure enough, that was right. Okay, the jobs data came in pretty soft today. Um, all the data is showing up rather soft on the employment side of things, and a lot of businesses are not hiring now. They've halted hiring, so that is a major shift from a year ago when there were all these jobs postings, and if you wanted a job, in theory you could get one. I'm not sure that's the case here today, right? And it's likely to get a little bit worse over the coming months. In fact, I saw one brokerage firm say that they expect non-farm payrolls to print negative this summer. So the next 2 or 3 months, they're forecasting a negative non-farm payrolls print. So if they're correct, it's just one firm and nobody knows anything, and they could very well be wrong, but that's a pretty bold forecast. So they're
Mhm.
seeing a trend in the data and the new hiring that's telling them we're going a lot lower. Like today's print was 175. So to be negative, that's almost a 200,000 payroll drop off. That's very significant, and that would tell you the Fed cannot hike in a situation like that. So I think the Fed is trapped here,
Mhm.
and the fact that it's a big election year just makes them that much more trapped. They can't fight inflation any more than they have, and they're going to have to support the Treasury in funding itself.
Mhm. And just for some context for our listeners, we're talking here on the morning of Friday, May 3rd. Just so you know when those jobs numbers came out and stuff. Robert, do you think that the Fed is going to have to change its target of 2% inflation because of, a lot of these issues?
Yes, and I don't think they will, emphatically state that they're changing their target. I think they'll just ease with inflation at whatever 2.8 or 3% or even 3.2%. I think they're just going to ease, and it will be sort of a stealth new inflation target. I don't think the Fed can say our new inflation, our new CPI inflation target is 3%.
Mhm.
I don't, or core PCE or whatever metric they want to use. I don't think they will ever say we're now targeting 3%, because that just causes a whole bigger slew of problems, and they begin to lose any shred of inflation fighting credibility that they still have. I mean, I'm not saying that they still have much, but they're not going to formally raise the inflation target to 3%. I think there's a possibility that they might stick to 2.2 to 2.5 and then say we're comfortable at the upper end of our range, was basically implying that 2.6% might be okay.
Mhm. Gotcha. Well, with the pullback that we've seen in many of the broad indices over the last couple of weeks, is it possible that the markets are, figuring this out finally as well, that the Fed wants to stay higher for longer?
Yeah, the market. So I think that's part of what's happened here in the last month, is that the market finally accepted that the Fed's not cutting rates 4 times in 2024. But still, the market definitely feels that the Fed has a bias towards easing, and there is still at least one more rate cut. There is at least a rate cut coming later this year. And following the non-farm payrolls data, that's now been priced up to 2 rate cuts. But as I said, nobody knows anything. So the market is just guessing. Powell's press conference on Wednesday was so wishy-washy. You know, he's just saying we're going to follow the data. We're going to follow the data. We're going to follow the data. We're not going to commit to anything. He's telling you nothing. He's telling you when the data changes in a significant way, then they will respond, but not prior to that point, right? So we're going to see the data almost at the same time the Fed sees it, like maybe a couple days later, but nothing is guaranteed at this point in terms of how the Fed is going to act. But obviously, the Fed has a bias towards easing because of the massive treasury deficits that have to be funded.
So when we think about, this backdrop of inflation, as well as, going into a contentious election year, are there a lot of similarities to the mid 1970s in this market and in this, let's say, this macro environment?
Yeah, I mean, in full disclosure, I was born in summer 1979, but I heard a lot about the 70s from my father.
Mhm.
And I have a lot of friends who are in their 60s. So I've heard and I've read about the 70s. And I think like my parallel is we're in 1976. I know not everybody agrees with that, but 1976 was an election year where Carter won the presidency, one of the arguably worst presidents in the history of the United States. And gold went parabolic from 1976 to January 1980. So if you pull up an annual or quarterly chart of gold going back to when it was allowed to trade freely in the early 70s, you'll see that in Q4 76, gold was just over $100 an ounce. January 1980, gold traded above 850 an ounce. So we're talking about 700 to 800% appreciation in just slightly more than 3 years. Um, the late 70s was nirvana for gold investors and for gold mining investors. And a lot of that had to do with the fact that government spending policies were out of control, and inflation rebounded aggressively when the Fed halted its fight on inflation uh, in 76.
Mhm.
And then that is well known as a major policy error, a major Fed policy error that they made that allowed inflation to roar to 15 to 20% by 1979.
Mhm.
So I feel like we're in 1976 right now. The parallels to 1976 are much stronger than not. 1976 was Cold War. There were some similarities in terms of what's going on in the world, today, although different in a lot of ways. Um, and when the Soviets invaded Afghanistan in 1979, it sent gold on that final moonshot that it did in the final days of 79 in January 1980. So there's a lot of similarities. There's a lot of, it's not going to be the exact same, but I think it rhymes pretty well, and maybe the world today is on hyper speed. So what took 3 years and 2 months in the late 70s might only need 14 months to transpire in today's, market environment. But either way, I think I want to own as much gold as I possibly can.
I'd like to shift to talking a little bit about energy, Robert. What do you see, with, obviously with this backdrop of conflict, energy is extremely important, but what do you see as critical energy investments at this time when it seems like there are a lot of very different beliefs in where the market is headed here?
Nuclear energy, uranium, number one. Natural gas, number two. And we're going green. So whether the viewers of your show like it or not, whether I like it or not, we're going to cleaner energy, cleaner. We can argue about that, and that'd be a whole nother podcast, in itself. But we're going green. So there's going to be a lot more solar panels manufactured over the next decade. A lot of electric vehicles. But uranium, I think, is the fundamental. It makes the most sense, in terms of its ability to generate baseload power over a very big grid that we need at a very low cost. And natural gas is just, it's abundant, it's cheap, and it's greener, right? It's greener.
Mhm.
So I think those are your fundamentals, but I also don't think we're getting off of crude oil anytime soon. I mean, I own a bunch of oil stocks here today. This week hasn't felt good for my portfolio, but I'm taking a longer term view of the situation, and I think for the world to really get off of crude oil, it's going to take a minimum of another 30 to 40 years. So these companies, some of these big oil companies are being priced as if we're no longer going to use oil in like 6 years, and that's completely unrealistic, and it's just not going to happen, right?
Mhm.
And even some of the forecasts for adoption of EVs, and even for the build out of solar panels and wiring the solar into the grid have been far too optimistic, and those forecasts and timelines are being pushed out another 5 or 10 years. So this whole it's like turning. It's not even an aircraft carrier. It's like 10 aircraft carriers. Like you're not going to turn the ship that big very quickly. It's going to take a very, very long time.
Mhm.
And so we're in the process of that. We have to use the tools we have available to ourselves. And even China is still building coal-fired plants, and in North America, we've completely kind of turned a blind eye to coal. But Germany is burning coal again, and China is burning more coal than it ever has.
And I believe Germany is burning more coal than it ever has as well, right?
Yeah, that's correct.
Um, Robert, in doing some research for today, I heard you say that that right now is an extremely interesting seasonal time for the biotech sector. What do you think explains that?
That's an interesting question. There's a lot of conferences. There's a lot of biotech conferences that happen during the summer. So there's a bit of a run up that happens in May and June in anticipation of some of these bigger conferences. And for whatever reason, companies seem to put out their data in late summer. So it's sort of just a weird, seasonal pattern that plays out over and over again. But buying biotech in late April and then selling it 3 or 4 months later has been a good trade more often than not, And so I tend to try to not overthink these technical patterns, and I just sort of take the trade.
Mhm.
And so just like this one, I took the trade. I bought biotech sector last week, and I'm long, and I'm up on the trade, and I'll see, if I can ride it throughout the summer.
As we're talking about trading, I also heard you say that you don't like to see gold move on war or terror headlines, and that you typically actually short it on that kind of news. Why is that?
It's transitory. It doesn't last. Um, War is often, emotional, or terror attacks. The headlines, it generates a reaction from traders and investors, and it's more of like a fear, greed, panic sort of a response. It's not a rational response. Like, I'm buying gold because it's going to maintain my purchasing power over many years and decades. Like, that's a logical thought. That's a rational thought that's based upon data. But because Iran attacked another country, or a bomb went off in a public park, or whatever it is, those are transitory. And while it affects people's lives and people die, and it can be very painful, at the end of the day, those events have happened literally thousands of times over the last 100, 200, 300 years.
Mhm.
It's transitory. So I want to take trades based upon uh, more longer term fundamental trends, not short term, like emotional responses.
What are some of the correlations that gold has followed for many years that are breaking down, and what do you think that this means? Is this a new era for gold?
That's an interesting question, Tom, because I don't want to say it's different this time, because as soon as I say that, I look at myself and I'm like, it's not. No. And you kind of put your foot in your mouth. But there's a lot of signs. There's a lot of evidence, there's a lot of data, that gold is in a structural bull market now. It's not cyclical. It's not a bull market that is based upon the Fed cutting interest rates. That's not a mandatory, like event that has to take place for gold to move to a higher price level.
Mhm.
And we've seen gold, uh, last October, gold traded 1826. I think it was October 7th. On April 12th, gold traded 24.48. So that is a more than $600 an ounce move in 6 months. That is something that you and I may have never seen before in our lifetimes. $600 an ounce move in that short a period of time. That's a very, very big move. Oh, and as soon as I say that, that's wrong. We saw that in 2020. So we've seen it
Mm.
twice.
Yeah.
We've seen it twice. It's not often. It's pretty rare, and that's a special move. And the Fed didn't cut during that time. The Fed has not done anything, since October of last year. So the Fed has held at 5.5 on the Fed funds rate, and gold has had one of its biggest moves over a 6-month period in history.
Mhm.
And the real interest rate is still positive 2%, 2.2%, whatever, still very much positive. And normally in the last 20 years, when gold has had a big move, um, real rates were trending lower or went into negative territory, not positive 2%.
Mhm.
So there's this tremendous tectonic shift in gold correlations that has taken place in the last 6 months. And it has a lot of people scratching their heads. What's happening? Like, hold on, the real rate is not going lower. It's still very positive. Why is gold going up? Or the dollar is not going lower. The dollar is actually higher or moving higher. Why is gold priced in dollar terms moving higher, right? So that tells you what is taking place is structural, and structural is a much stronger foundation. It's like the structure of a house. You pour the concrete. Gold is moving up on a much stronger foundation than it did in May or June of 2020, when it just popped aggressively because the Fed was pouring trillions of dollars, into the economy and markets, right? So we're in a structural bull market. The structural bull market has a lot to do with the macro picture. The macro picture is the global picture. A lot of it has to do with what's happening in the East, in China.
Mhm.
And the Chinese do not want to be subject to the whims of the US president or the US government, or the US populace, and what they feel the world should look like or be like, or how trade should be conducted, et cetera, et cetera. And also, something that is not very well understood, I think, in North America is that the China debt bubble is bigger even than the US debt bubble. Okay, so China's total debt, both public and private, to the size of their economy is more than 300%. In the US, we're about 230%. So China has us beat in terms of total debt. And by all accounts, their debt bubble is breaking or popping as we speak. So there is a move into gold, both by the Chinese government, the central bank stockpiling it to bolster their currency, but also by the Chinese populace buying gold as a hedge to their entire portfolio, including the real estate and property that they may own. It's been falling in value for the last couple of years.
Is there anything, important to understand about how that debt is structured, though, Robert? If we look at the example of Japan and how they own a lot of their own debt versus the rest of the world owning the US's debt, is there a big difference there between China and the US in terms of how that debt is structured?
That's a good question. I'm not exactly sure about that, but I know that the government is basically, implicitly backing a lot of property debt throughout the Chinese economy. And so when that debt goes to debt heaven, essentially when it fails, the government is thought to have to backstop it in some way, shape, or form.
Mhm.
And so what that basically means is the central bank is generating new yuan out of thin air. And in theory, that should lower the value of the currency, right? And so the move into hard assets is a counter move to a bursting debt bubble. Just the way the system is run in China, there could be a lot of companies, private companies, or even public, that have big debt piles that are going bad. They are not able to pay back the debt. And at the end of the day, the government is the backstop for everything in China. So while the government may allow a couple of companies or a couple of private individuals to fail, it will not allow the system to fail. And there will be bailouts, right? And the outlet for any debt bailouts is always the currency. The currency has to pay the price, because in order to make bad debt good, you have to print money.
Mhm. You know, as we're on this topic of how central banks act and, let's say, the effect that they have on the market, you know, you mentioned when we were speaking about the correlations that are breaking down, that the Fed really hasn't done anything over this, you know, big price rise in gold. But I think we could make the argument that the Fed, in a way, has an effect on the market without them actually needing to, you know, really change the overnight rate. The Fed can come out and make a statement, and the market actually does a lot of the easing of monetary conditions. And I think that's, you know, important to consider how much of an effect the market has over the monetary conditions, right?
That's absolutely right. Yeah, the threat is stronger than the execution. And so when Powell had his final press conference of 2023 and left everybody with an extremely dovish, impression, financial conditions across markets in the economy eased significantly over the next couple of months. And that probably helped to sort of stoke this rebound in inflation that we've seen in Q1 and Q2, right? So perhaps Powell made a policy error by not taking any policy action at all, by just being dovish and sort of allowing the market to set expectations. I mean, the Fed never said ever in any press conference or any dot plots to expect more than 3 rate cuts in 2024. They never said it.
Mm-hmm.
The market took that and ran with it and priced at 6, right? And this is sort of the problem, you know, the Fed job owning. And in some ways, I think the Fed is making a mistake by talking too much. Too many Fed governors are giving speeches and putting in their 2 cents on things, and when rate cuts might start, or whether we need to hike again, or whatever. Is inflation too high? Is the policy rate restrictive enough? Everybody's throwing in their 2 cents. All these Fed speakers, these Fed governors. Powell is speaking more than he should, quite frankly, and it's creating this yo-yo in market expectations, where we went to 6 rate cuts, then we went to no rate cuts. Now this morning we're back to 2 rate cuts, and I just go back to nobody knows anything, right? It's a big clown show. But you're right. The Fed moves the market just by talking. It doesn't have to do anything.
Yeah, you know, as you're explaining that, that was exactly what I was thinking, is going back to one of your favorite sayings, that nobody knows anything, right?
Exactly. Because Powell doesn't even know what he's going to do, right? So how can the thing is that people are paid to comment on the stuff and write, research, right? Like Bank of America has got to write a commentary on the Fed announcement and press conference. So they have to say something. It's their job.
Mm-hmm.
But really, nobody knows what the Fed is going to do. We think we know the Fed wants to ease when it can, but it can't yet, just because of the data.
Mm-hmm. So on the other side of that, you know, if we're looking at data to be able to, you know, try to understand, let's say, where the gold market is heading, what can we learn from the positioning of traders about where the gold market might be headed? And what are some other times in history where they were positioned, close to where they are now?
Well, so a few things about that. Number one, I much prefer buying gold in January and February when the CTAs were not long.
Mhm.
Now the CTAs are long. I mean, in early April, the CTAs got very long. They got $27 billion net long in gold futures, right? I'd rather not chase the gold price in the short term when the CTAs are that long, right? But fade the scene to today, they've trimmed back a little bit. I'm not sure what the latest data is, but let's just say they're still 20 billion net long. But the thing is, when we look at US data, we're only seeing one slice of the picture in terms of the world.
Mhm.
And we have to look more and more towards Chinese data and what Chinese traders are doing. And the money flows are there because the game has changed. It's not just a COMEX game anymore. It's not a North American game anymore. It's global. And really, China is driving the gold price more in 2024 than traders, and the US are driving, the gold price. Based upon the entirety of the data, I would say, we should expect gold to cool off further for at least another couple of weeks. Now, that doesn't mean it has to go down a lot. It just sort of trade sideways and bore people. But yeah, when it got to 24.48 on April 12th, and I looked at the COT data that afternoon, I said, we're in for a correction. And we were.
Mhm.
I wouldn't be shorting gold at 2,300. In fact, I would still err on the side of being on the long side of it in terms of even short-term trading. But it would make sense when we got so overheated in terms of speculative net length a couple of weeks ago that we would see a further cooling off for another 1 to 2 weeks. And I want to be clear on my time frame. So what I was just talking about, short-term time frames, so we're talking about weeks or maybe a month. Long-term, as an investor who's investing for the rest of my life, I'm 44, so I'm investing for another 40, 50 years. I am unmoved by the recent volatility in the gold price. If it goes up 200, if it goes down 100 in a day, I'm unmoved. It doesn't matter to me one bit. I just want to be steadily accumulating a few more ounces of gold every month or every few months for the rest of my life. And that's sort of how I take my long-term view towards gold.
Mhm. Well, as you're explaining that, that seems like one strategy for not getting shaken out of a bull market here. Do you have any other strategies to, be able to gain perspective like that to stay in that market when it does, surprise, let's say, to the downside?
Well, I'd say, for me personally, I can only speak for me. Sometimes I will sell call options on the gold ETF when it gets very, very overheated and overextended.
Mhm.
And sometimes I may even short a couple of contracts in gold futures, like on the morning of the 12th of April, when it hit 24.48. And in some ways, that sort of is hedging my long-term holdings. But you have to be very careful when you're doing that because you're trading futures. That's a leveraged vehicle. It's not a long-term vehicle. It's a short-term vehicle it's a trade you have to close out by a certain date. And that's not for everyone. Okay, so you can hedge by selling calls, by shorting when things get a little overextended. But short of doing that, and if you don't want to do those things, you just want to sort of approach it from a psychological standpoint, you have to look at the big picture, right? And so I would recommend zooming out to a 20-year gold chart, 30-year gold chart, look at the monthly or quarterly charts and put it into perspective.
Mhm.
And think about where gold got to in 1980, 850. What is that in today's dollars? If you adjust that for inflation, what's that number? I don't have the number on top of my head, but it's much higher than 2309. And that big long-term cup and handle pattern. So until that pattern is somehow broken, and, you know, null and void by a breakdown back through 2000. I think you have to stick with the long-term trend, this secular structural bull market breakout. And you have to think that the real upside here is not 2,400. It's not even 2,500. You know, it could be 3,000. It could be 4,000. And I won't go past the 4,000 target because that's already pretty lofty, but it's a much higher number. It's a much higher price per ounce of gold. So why would you be worried by some short-term volatility between 2,400 and 2,300 or what have you? I mean, that's a 4% move. You know, the move from 2,400 to 2,300 is 4%. Stocks move 4% almost every day of the week. So the volatility is just, you know, it's to be expected.
So how do you end up, let's say, expressing your interest in all of these markets? How do you structure your portfolio? And do you have any rules in how you allocate your funds?
Good question. I'll try to break it down as simply as possible. So number one, I have my physical metal.
Mm-hmm.
For me, that's my savings account. I don't have a savings account at a bank with $50,000 in it or, you know, $100,000 in it. I have physical gold and silver. That's my savings account.
Mm-hmm.
And I think of that money, number one, it's hard for me to access. So even if I needed some money for it to buy a car or whatever, I wanted to go on a nice vacation, it wouldn't be practical for me to sell that. So I need to find the money somewhere else. So I steadily accumulate gold and silver over time, and I don't even think about it. In fact, if you ask me how much I have today, I would have to really think for a few minutes how much it is exactly. Because I try not to think about it. Like, that's the money that I don't touch. It's not even really, like I don't even think it's mine.
Mm-hmm.
As far as money in brokerage accounts and like in the financial system.
Robert, if I could just interrupt for 1 second. When you're trying to accumulate physical ounces, are you looking at the gold to silver ratio and going, you know, let's say investing in silver based off of that long-term undervaluation, maybe reversion to a mean play at that point?
No, I don't. You know, to be honest, I don't really care a whole lot about the gold silver ratio. I think about it sometimes in terms of when silver gets really undervalued. And that would be, in my mind, if the gold silver ratio moves to 100, then that's the time when you buy a lot of silver. But if it's 80 or 75 or whatever, it doesn't come into my thought process at all. I definitely have more silver ounces than gold ounces, but that's you know, that's obvious, you know, just because of the price. But you know, if I have a bias between the two metals, it's definitely towards gold.
Okay.
And then, so in terms of portfolio construction, you know, this is going to be different for everyone based upon their age, their income, their, you know, investment objectives, their time frame. But I'll just say for me, I think of my junior mining portfolio as completely separate from all my other stock holdings and my trading. In fact, I have two separate accounts. So my junior mining portfolio is just junior mining. And my other portfolio is for my trading and my swing longs. Like, I'll have, you know, Freeport McMoran, Barrick Gold, or what have you, large cap stocks that I'm holding for many months or for a year. That's in a separate portfolio. In the junior mining portfolio, I'm taking like 25% of my net worth and I'm putting it in that basket, right? And I'm accumulating junior mining companies that I think have the potential for a 10x at some point. Companies with which I've spoken with the management. I know the management very well. I've done a lot of DD on their projects. I have a pretty clear idea of what potential catalysts might be. And I'm buying and selling just in that portfolio. And I try to keep at least 20% of that. So of the 1/4 of my net worth that's in junior mining, I try to keep 20% of that in cash as much as I can so that I can trade and I can take advantage of new opportunities.
Mhm.
If I go fully invested and the sector goes into a real downturn, I'm stuck and I can't buy more. I'm just stuck with what I have. And for me to raise new cash, I'd have to sell something. And I prefer not to be in a situation where I have to sell a stock in a bear market or, when it's dropped for non-fundamental reasons, right? But yeah, so I hope that gives you some ideas. So I'd like to take 20% of my net worth in physical metals as my savings account. I'm not touching it. I'm adding to it as I grow my income and my net worth over time. I build my savings in gold and silver. And then I take 25% of my net worth and I'm willing to risk it in junior mining, where that portfolio can and has had 50% drawdowns regularly over the last 10 years, but it's also had big upturns of 300%, 400, and I'm willing to go on that ride with that portion of my net worth.
Mhm. So do you have any rules in what you look for in juniors as far as it comes to, let's say, share structure or jurisdiction, anything like that?
I mean, I have a lot of rules. I have a lot of blog posts on this stuff. You can read it all if you search it. Share structure is a big one, Tom. Investors should look at the SEDAR filings for junior mining companies and dig into the share structure. What certain shares were sold at in seed rounds, in the IPO round, previous financings, look at warrants, options for management. You should really dig into the share structure because share structure is a key fundamental in a junior mining company. I mean, really, it's a fundamental in all public companies, but really in junior mining, more so because these companies don't have revenue and net income um, for investors to value the company upon. Junior mining is, inherently speculative in nature because of the fact these companies 99% of the time do not have revenues. They don't have cash flows for you to gauge the valuation. You are gauging the valuation on what you think of the management team and how good the management team is at, achieving key milestones and keeping their promises and generating value for shareholders. And then the quality of the assets. And the assets are often subjective. When investors look at them, 10 different investors could have 10 different opinions on the same project, right? So you have to dig in. It's not for everyone, that's for sure. But share structure is a key fundamental. How management got their shares, how they've acquired the shares over time, what's their skin in the game, and then trying to get a really good idea of what is management's end game. Like, what's their strategy for how they make their money? Is it only through salaries and stock options? Or is it a formative transaction at some point in the future that will create a windfall for all shareholders? Right. So there's a lot of things to dig into, but I think share structure is really key. So you don't, like, if you see a company with like 500 million shares out and 8-cent stock and there's 50 million warrants at 10 cents and management is giving themselves tens of millions of options every year, then that's probably a sign you just want to walk away from it. You prefer to have a tighter share structure where management is regularly buying shares on the open market, regularly writing checks in the company's financing. So they are showing they have skin in the game and they're not just doing this as a lifestyle company. And then talk to the CEO, talk to the CFO, talk to the team and get a feel for who they are as people and what are they up to. Like, why are they doing this? Like, why are they spending their time involved in this company? And then you can make a decision based upon your intuition as a human being. are these people that I want to invest in, or time to go on to the next one?
Mhm. Earlier when we were kind of touching on why you like the biomedical field and the junior mining stocks, you were saying that they very often they can have a blockbuster PEA that just surprises and smashes the market, and then everybody wants that stock. If we're seeing, let's say, a drill story develop over time where they're constantly putting out positive results, do they really need a blockbuster PEA, and do they need to do all that work, or is the market very likely just paying attention to that stock as those drill results are released, not
Yeah, no, it's
necessarily.
a new discovery. Like if it's a new discovery and they keep hitting, with the drills, then
Mhm,
yeah, don't put out a resource, don't put out a study, just keep drilling and keep hitting.
mhm,
And eventually the company will get acquired by a major mining firm. But yeah, I was just throwing that out as an example of a catalyst that could come about that could create a re-rate in a company. Usually, a PA is not going to create a 10x. At best, it might create a 2x, but still, it could be a significant, appreciation in the share price. But there's nothing like a drill hole that people are gawking over. I'll just make something up like 30 grams per ton gold over 40 meters in a blind discovery. Then you're going to have a 10x. I mean, if the share structure is tight enough and the market cap is small enough, a hole like that will create a 10x in a week.
mhm,
And I just completely made that up. But something that is absolutely eye popping, nobody expected. The markets move when they're surprise to the upside and surprise to the downside.
mhm.
There's plenty of downside surprises that we've seen in the stock market over the last couple of years. Even in the mining sector, there was a pretty major mining company in Turkey that had their leach pad basically, implode and kill 9 workers at the mine. So that was an example of very negative downside surprise, and the share price cratered just like the leach pad did. But on the upside, if it's a younger company with a tight share structure and a 20 million market cap, and they drill 40 meters of 30 grams per ton gold in a blind discovery, then everybody is going to be with their mouth agape. I need to own the stock. And that's how you get that 10x torque. But how many times do we see 30 grams per ton gold over 40 meters in a blind discovery by a junior? Maybe once a decade,
Mhm.
right? But it's possible, right? And it's that possibility that has us play this game, that has people keep coming back for more, even though it is so fraught with risk and pitfalls.
Mhm. Yeah, it can be such an exciting space. Um, and I think that as gold gains more momentum, and we, let's say, the broader investing public kind of comes to rediscover gold, I think that a lot of these stories are going to make a lot more sense, and get a lot more exciting. But as you're talking about being, let's say, surprised to the upside or the downside, when we feel very smart about a trade that we put on, what is that typically an indication of?
You're about to get smacked across the face. Yeah, no, I mean, I've been humbled in this business more times than I could possibly count, right? And uh, it is very humbling as an investor. The management teams are regularly humbled as well. Um, it's a tough business, right? It both, from an investment side and from a corporate side. And as an investor, um, whenever I feel like I'm having a really good run, wow, the last couple of months have been fantastic. In the back of my mind, I think, oh, hold on, you've been here before, Robert. And what happened the time before and the time before that is you lost a bunch of money a few weeks later, And so you always, can never feel too comfortable, never feel too confident, as an investor, either in precious metals or mining or biotech or just in the stock market more broadly. And so we have to try to make effective choices to try to minimize our downside variance as much as possible, but also just always be accepting that the risk is there, and just, embrace that once in a while the market's going to slap us pretty hard across the face and shake it off and get back up again, and yeah, I mean, you never want to get complacent, and I'll just add one more thought. One of the mistakes that I've made more than once in the last 20 years is I have the biggest risk on when the market share prices are the highest.
Mm-hmm.
So I become more comfortable buying the higher share prices get, the higher the junior mining sector goes, the higher the biotech sector goes. I am layering in more risk to the point that in the past, sometimes I've even been on margin at market peaks, and that never ends well. And a lot of investors do the same thing.
Mm-hmm.
In reality, you should be taking off risk when a big run has happened. Your portfolio's had a couple months of moving up regularly, like almost every day, every week. Take some risk, raise some cash, take some risk off, raise some cash, so you have a little more flexibility in case a steeper pullback does happen. Because even in a bull markets climb a wall of worry. You can have violent 3 or 4 day shakeouts during a bull market run. So you want to be able to have some cash to take advantage of those when they arise. And also just from a psychological capital standpoint, you sleep a little better at night, taking a little bit off the table. Mm-hmm. And get rid of the FOMO thought. Oh, but if I take 20% off, then if it keeps going up, I'm going to miss out on all those potential profits. Just as soon as you start thinking like that, change your thought. Mm-hmm. Change your thought. FOMO, the fear that you're going to miss out on more gains, on more greed, is not effective mindset for a market participant. Okay.
And I think on the opposite side of that, whenever you feel like something is a real piece of crap and it's just not performing, analyze if the fundamentals have changed, and if they haven't, that's probably a good time to buy as well. Like that, the old adage of hold your nose and buy, or buy when others are fearful. I've learned those lessons through these markets as well in my short experience, and I couldn't agree with you more. When you feel like you're the smartest guy in the room because of this trade, as well as when you think that something is never going anywhere, those are really interesting indications and can be great inflection points.
And I'll just add to that. Just go back to February. Newmont Gold, the biggest gold mining company in the world, put out earnings late February. Market didn't like the results. Newmont stock cratered even further. Briefly, during one trading session, dropped under $30 a share. And if you looked at X or CEO.ca or Stockhouse or wherever, every comment about Newmont was how awful this company was, how terrible the management team is, how poor the execution is, what a POS this company is. That is the time to buy. Mm-hmm. When it's absolutely unanimously and universally hated, you buy it. And especially when you have a bullish view of the gold price, and this is the biggest gold mining company in the world. So yes, their execution has not been ideal for the last few years, no doubt about it. They've had some growing pains with some of the acquisitions that they've made. But if everybody hates it, that means everybody has sold it and nobody owns it, right? And therein lies the opportunity. It's not priced for any good news. In fact, it's priced for more bad news. That is when the odds are the most in your favor as an investor.
Mm-hmm. Well, Robert, I really appreciate you sharing all of these perspectives with us today, and these lessons that you've learned through the years. But I want to kind of wrap up on a bit of a different note. Why should we always believe in the power of yoga pants?
I am such a bull on yoga pants. Lululemon, great company, great clothing. I'm wearing Lululemon right now. So, as a man, I love their men's line. So that's number one reason. But yoga pants make women look amazing. And they sell a lot of yoga pants and make a lot of money by selling yoga pants. So always have confidence and buy the dip in yoga pants because they'll always come back.
Well, Robert, I appreciate being able to kind of to wrap on that point. But is there anything that you want to leave our listeners to think about before we do?
I think the final thing, and I don't want to be too dire in this commentary, but stick with what's working.
Mhm.
And copper, gold, and silver are working, and these metals and more um, are the building blocks of mankind and of the world. And we need more and more of them for various reasons over the coming decades. And I think we just go back to Zoltan Pozar and his 4 points: rewire, rearm, reshore, and restock. And if you think about those 4 points and what has to happen in the world for those things to occur over the next decade, how can you invest to profit from those trends? Because I feel very confident that those trends are going to only get stronger in the years to come. Rewiring, the green transition, reshoring, everybody wants it in their sovereign borders where they control it and they can acquire it. Restock, we need more commodities. We need more metals, and countries need to build up their stocks, their stockpiles of these metals, and then rearm. I mean, um, I think we can say we're in World War III. We are in World War III now.
Mhm.
So Europe is rearming. The U.S. has to rearm itself, and all of the countries in the world are going to continue to build up their armed forces, and all of that requires a lot more metals.
Absolutely. It's just this broad theme that we have to be patient, but understand the fundamentals of that are going to play out, whether we get discouraged in the short term or not.
Yeah.
So
100%.
for anybody that wants to find more of Robert's work, you're at Goldfinger on CEO.ca, Goldfinger Capital on YouTube, CEO Technician on Twitter or X, and Robert Sinn with 2 N's on Substack. Anywhere else you'd like to point out?
That's pretty good. I got a lot of different platforms. I think you got the key ones.
Perfect. Robert, thanks so much for your time today. Really appreciate it.
Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.